if you look from a BRICS or global source perspective, there's no doubt that a central bank in this region will keep increasing their holding in physical gold and reducing their assets in US Treasuries and other US dollar assets because it's a geopolitical matter. It's not, in fact, an economic or financial matter. It's a geopolitical matter, and it's a matter for these countries which have seen what happened to the US dollar asset owned by Russia and which were frozen in 2022 when the war between Ukraine and Russia started. So these countries will not take any more risk to own a US dollar asset. So
welcome back to Metals and Miners. I'm your host, Gary Boehm, and today we're digging into the exciting world and volatile world of precious metals, mining, markets, and geopolitical trends. I'm thrilled to introduce my friend, Laurent LeQueu, the insightful publisher of the Macro Butler. Laurent, it's an honor to have you back on Metals and Miners. Welcome to the show.
Gary, it's my pleasure to be back on your show.
Okay, Laurent, you have decades of decrypting how macroeconomic data impacts the global investment landscape across many asset classes. Right now, we're in the middle of this historic global monetary and investment shift that's taking place. What do you hope for those tuning into our conversation today that they'll walk away with after listening to our discussion?
Well, I hope that all the listeners of this discussion understand that the risky assets are not those they have learned they were. And in fact, in the current world environment we are in, risky assets are among fixed income assets, especially government bonds, and also among cash. While those assets that everyone should own in this current environment is what Harry Brown in the permanent portfolio called properties, and these are stocks and, of course, precious metals, and among the precious metals, of course, gold.
Okay, so we have a lot to dig into today. Let's start with the markets. Despite the tariff war, debt issues, supply chain concerns, the political divide, geopolitical concerns, etc., the markets have remained elevated around all-time highs, and they don't seem at all close to cracking. Many have been predicting a bursting of the market bubble for the last several years, but it just never happens. And at this point, it seems far from happening, as the fourth quarter earnings expectations, they're growing, they're not shrinking. Should investors in the markets at this point have earmuffs on to tamp out all the noise, as really what's happening here is the Trump administration, they have been and they will be pulling every lever, monetarily, fiscally, regulatory-wise, in order to ensure that growth outpaces debt, and therefore the markets will at least nominally continue to go higher from here?
I think that since the start of this decade, the world, and including the US, has been in a structurally inflationary environment. And once again, if we look at how asset classes behave toward the business cycle, I mean, it is clear that when you are in an inflationary environment, you must own properties like stocks and gold, and you must avoid to own contracts like bonds and cash. And in fact, I also put the recent performance of equity markets in the Western world in the context of history and what we have seen in emerging markets. In fact, if we look toward history at emerging markets, when investors and consumers and citizens have less and less trust in their public institution to solve their own problem, can be a social problem, economic problem. In fact, we have seen a flight out of bonds into equities, because structurally inflation is driven, in fact, by a decrease in the trust that investors and consumers have in their public institution. So I think that what we have experienced and we are still experiencing in the Western world is in fact what many emerging markets have experienced in the past, meaning that when investors have no more trust in their public institution to solve the economic problems, and where the economy is in a structurally inflationary environment. In fact, valuation of stocks don't really matter at all anymore, because owning a share of, let's say, Walmart, of ExxonMobil, will always be worth much more than owning a treasury bond at the end of the day. And so I think that, yes, you continue to see a positive earnings revision for the stock market in general. But I would think that over the next few weeks and months, we are likely to see a rotation that has already materialized one way or the other over the past few weeks, meaning that what has worked so far this year, meaning the AI trade, or let's say the Magnificent Seven trade, is less likely to work for the future, and especially for 2026, as the US economy, like the rest of the world, is heading in a stagflation. So if we are heading into an environment with low economic growth and structurally high inflation, in fact, among stocks, investors should focus more and more on energy producers or materials, mining companies, or even industrial companies, rather than on energy consumer, which are typically your AI stock, your Magnificent Seven. So I would think that, and I think that we will see once again volatility in the stock market over the next few weeks. And this volatility, in fact, should be mostly driven by the rotation out of energy consumer stocks into energy producer stocks. So my advice here, and it's not an investment recommendation, but would be for investor to look more towards these energy producer companies. And here, when I talk about energy producer, I really look at energy producer from a broad-based perspective. So it's not only the oil and gas sector, which is still unloved and under-owned by many investors, but it's also the mining stocks, which have done pretty well, I mean, over the past few weeks, but I think are still under-owned as well by many investors. And then on top of this, there are also all the industrial sector, which will most likely benefit from a new commodity boom, which could appear in the next few quarters, or by, let's say, mid-2026, where we will see increasing shortages in commodities, driving prices higher. And I mean, by that, we will see also companies that are all directly or indirectly related to the commodity sector performing much better than they have done in 2025.
Yeah, and I think you make a really great point that as trust in the government wanes, for them to be able to properly handle the business of the people, the flight out of treasuries or sovereign bonds towards things, stocks, precious metals, et cetera, it only increases. It makes a lot of sense. Let's continue to talk about things. Let's discuss, Laurent, the electrical grid and the need for modernization. I mean, so we have this AI, electrification of everything, the robotics boom that's coming. We have so much draw, not to mention, population growth, et cetera, and just general advancement. You have so much draw that's needed off the grid, yet the grid is antiquated, it's old, it's almost like trying to plug in all this brand new technology into some old cassette tape, VCR type, technology. We don't just need to expand the grid. We need to modernize the grid in order to get the greatest benefits and efficiency, et cetera. All across the United States right now, we're seeing spiking electricity rates. Massive energy chugging data centers are going to be coming online. And, we see a lot of the Mag 7 looking to acquire energy sources in order to power them, but some of those energy sources may not be available right away or available for years to come. Anyway, the grid desperately needs to be updated and massive energy sources need to be tied in to support it. How do you expect this grid modernization to unfold, as we move forward? And where are you looking to capitalize on it?
Well, there are many challenges for the upgrade of the electrical grid in the US. I mean, a few months ago, I wrote a piece about wattflation. And in fact, I think that we have seen clearly in the CPI that the price of electricity has become an issue for every consumer. So it's not only industrial consumer which suffer from this rise in electricity prices, but of course, a domestic consumer. And we know that, inflation is a very political sensitive matter around election. So I guess that since we are almost 12 months before the midterm election, this is a subject that is likely to come on the table even of the current administration quite quickly. To address the upgrade of the American electric grid, I would say that it comes first to, I would say, favor new source of production. So I think that we have seen quite a hype around nuclear power and uranium miner companies. Because it seems, at least from now, that the hyperscaler, the Magnificent Seven, have decided to look at nuclear as the way to produce the needed energy for their AI data center. I would say that the issue for the US here is that, even it has uranium mining project ongoing. The US is not particularly rich in terms of uranium, and it's depending until now, in fact, on imports from Russia, Kazakhstan, and Canada. So I would say that this is probably a long-term solution to the upgrade of electricity supply in the US. Of course, the other source of primary energy that electric producer could use is, of course, natural gas. And here we all know that the US has been blessed with ample and cheap resources of natural gas. The issue here is that the price is not high enough to stimulate exploration and production. We have seen the latest results from Halliburton, Schlumberger, and other oil and gas services companies have not yet shown any signs of drill, baby drill kind of development. So I would think that, and also because most of the oil and gas E&P company in the US have been under pressure during the previous administration. They were unable to raise funds. They were unable to borrow the requirement money to start a new project because of the ESG narrative. So they are very, very cautious in terms of spending aggressively in terms of exploration and production. And I would say that as of now, it's still cheaper to find oil and gas on the New York Stock Exchange floor rather than on the Permian Basin. meaning that we are likely to see further consolidation in the oil and gas sector before we see a major increase in gas and oil output in the US. So this clearly doesn't solve the problem of trying to produce more electricity over the next 12 to 24 months. On top of this, I think that the US is also lacking of manpower in this sector, meaning that unfortunately for the US, the young people over the past decades have preferred to focus on history and philosophy rather than on electric engineering and anything related to power generation. And this is also clearly a challenge for the US. So, I mean, this could be easily solved by the current administration by pushing a new generation of Americans to start studying any kind of work and job which are linked to the electric grid. But once again, I mean, it will take at least 2 to 5 years to have a qualified manpower to, I would say, get the electric grid upgraded. So I see a lot of challenges for the US over the next 12 to 24 months. I think that what is clearly required to be done by the current administration is to prioritize CapEx in terms of electric infrastructure. And I would say that it's not only electric infrastructure that the US needs. The US is also in bad need of improving its infrastructure in general. And once again, I think that if I compare, because I'm based in Asia, so I get a sense of all, I would say, the quality of infrastructure here in Asia. And clearly, whatever any American investor can say, the good thing that the Chinese government has done over the past 5 years, it has been to focus on improving infrastructure, communication infrastructure, as well as energy infrastructure. So China has not the chance like the US to be blessed with ample resources of energy. But I think that because they have decided to focus on developing new source of electric energy, and I'm not only talking about green energy, but also they have been focusing, in fact, on investing massively in nuclear power energy over the past 5 years, and they have clearly developed a know-how that, in fact, the US is lacking today, because, I mean, it has been many years that a new nuclear power plant has been opened in the US. So I will say that it's going to be a big challenge for the current administration to deal with this whatflation, because clearly also one other way to deal with this would be to limit supply from the hyperscaler and to oblige the hyperscaler to pay the price for these higher electricity prices. But I don't really think that that's the way that the current US government would go. So, I mean, you don't build a power plant in 6 months. You don't refurbish your electric grid in 12 months. It's something that needs at least 1 to 2 years. And probably in the meantime, unfortunately, every Americans will have to pay the price on the electricity bill.
Yeah, so there's a lot of problems here, a lot of challenges, and a lot of risk, as you just laid out, all at the same time that, you know, the government is not going to stop the AI race. So there's just a lot of competing things for the grid and for reasons to keep it going. So that is why I put together an all-star panel for November 12th. We're going to have a live webinar event to discuss this. The group is going to help investors get positioned ahead of the curve that's coming. We know that this grid has to be updated, has to be modernized. Luke Roman is going to be the keynote speaker, Dr. Nomi Prinz, Larry McDonald, and Kevin Goldstein. They're going to be speaking on the various aspects of the grid, from the metals to the energy to the actual electrical infrastructure that's going to be needed. Folks who attend this are going to have an opportunity to hear some investment ideas to get ahead. I urge everybody to secure your seat today. All right, Laurent, let's move on to gold. Earlier this year, gold passed the euro as the second most owned foreign reserve asset by value. It is still quite a bit away from passing the US dollar as the number one owned foreign reserve asset. Despite dips, drops, and volatility, do you expect gold to eventually catch up to and pass the US dollar as the most owned foreign reserve asset by total value? In fact, do you see this as a collision course between gold and the US dollar that they're on? And as this battle advances, do you expect there to be, some artillery thrown, so to speak, by the big boys at gold in order to keep the US dollar in the number one pole position that it's been in for decades?
Well, I think that if you look from a BRICS or global source perspective, there's no doubt that a central bank in this region will keep increasing their holding in physical gold and reducing their assets in US Treasuries and other US dollar assets, because it's a geopolitical matter. It's not, in fact, an economic or financial matter. It's a geopolitical matter, and it's a matter for these countries which have seen what happened to the US dollar asset owned by Russia and which were frozen in 2022 when the war between Ukraine and Russia started. So these countries will not take any more risk to own a US dollar asset. So I think that we will see a continued increase of gold reserve among the major BRICS and global South countries in the next few years, unless with the very light probability that the world is going back into a global peace environment, which is, to me, very unlikely. So if you ask me clearly from the global South perspective, and we have already seen also, it's not only central bank in this region, we started to accumulate gold and replace US dollar assets by gold, but also institutional investor, pension funds, and at the end of the day, also retail investor and high net worth individual, because they have also seen that if they own the wrong passport and own some US dollar asset, their asset could also be frozen. So I would say that this will come, structurally, these countries will keep accumulating gold and reducing their US dollar asset. And this comes at a time, in fact, where these countries are generating less and less US dollar, because most of these countries, especially China, trade less and less with the US, trade less and less with the Western world. And when they trade between each other, in fact, most of the time, they trade in their local currencies. So not only they don't need anymore to hold as many US dollar in the past, since China can buy Russian oil in renminbi or Thailand can buy a Chinese car in Thai baht. So, I mean, in this perspective, clearly, we are heading into a world where the global south, the BRICS, see the US dollar as a weapon against them. And since they don't need as many US dollars as in the past, the only asset that they can use as of today, and I think for the foreseeable future, to replace the US dollar asset into their reserve is physical gold and potentially silver. We have seen the Russian central bank has started to build a silver strategic reserve. So we could see at some point, I would say it's not very far-fetched to me that at some point China or India also start a silver strategic reserve in their global in their domestic institutional reserve. But if you ask me, so if we are heading into this kind of world which is increasingly polarized, where one part of the world doesn't really need US dollar anymore to trade and doesn't really need US dollar anymore to save. In fact, I won't be surprised that I would say by the end of this decade, gold replace the US dollar as the largest asset in the reserve of this country. When I look at the Western world, I mean, the Western world, I include the European Union, Japan, South Korea, and probably Australia. In fact, these countries are still mostly dependent of the US for their, I would say, geopolitical protection. They are still mainly trading with the US. So these countries are likely to continue to need to keep a US dollar asset. And in fact, what I think is a likely scenario over the next few quarters and years is that because you see the situation in Europe, in the Eurozone, including and as well as the UK deteriorating. In fact, you could see many Western investors shifting their assets from the euro, the pound into US dollar, because for them, the US dollar will still be kind of the safest asset to own outside gold. But also, there's not a big culture of owning gold in the Western world. I mean, we all know that European central banks, including the Bank of England, have been selling gold when the gold price was below $1,000 per ounce. I mean, Gordon Brown has been quite famous for selling the bottom in the gold price. So I guess that for these countries, you could still see an interest in US dollar asset, but I would say this will last as long as these countries remain dependent of the US for their trade relationship as well as for their geopolitical protection. So all in all, it's difficult to answer your question because I would say that, on one side of the world, if you look at the BRICS and the global south, I guess it's no doubt that we will see gold emerging as the major source of reserve for assets, and probably the only one, the ultimate one, at some point in time, probably at the end of this decade or by the start of the mid of the next decade. While on the other side of the pound, I mean, the US and all the countries that are still in the satellite of the US will most likely still need to own US dollar assets.
Yeah. Okay. So yesterday in the gold market, it was an absolute bloodbath. It was a 5+ sigma event to the downside. Yesterday's smash down of gold turned out to be a once in 63-year event, mathematically speaking. There was no news or structural change to the macro backdrop that is still intact. In fact, it includes the massive global debt crisis, the bifurcation between the West and the BRICS, the moving from a US dominant hegemonic world to a multipolar world, the de-dollarization movement towards the gold net settlement trade that you talked about, the annual purchasing of about 30% of all available gold supply by central banks annually, the continual purchasing by retail consumers in Asia and India, which you've spoken about, the geopolitical problems and more. It's not like the US and other nations have cleaned up their debt situation, or central banks have stopped buying gold, or the BRICS decided to go back to net settling their trade in with treasuries instead of gold, or that world peace has broken out and been achieved. There was literally zero change to the macro backdrop yesterday, and yet gold just experienced a once in 63-year event. Why do you suppose that is?
Well, I don't have the answer to this question. I have to be honest with you. I think that there are many parameters and many algos which are driving also the gold price at the short term. I also think that some big boys in the gold markets may have some interest to calm down the price appreciation in the gold price at some point. So I don't want to come here with any conspiracy theory. I think that, I mean, investor should be used of this kind of volatility, because the more investors there are in the gold market, the more players who are interested in the gold market, I think the higher the volatility in the gold market will be. We have a lot of also day trader, retail investors, which are also investing in gold nowadays on margin. So imagine, I mean, in this kind of environment, they have margin call almost immediately. And of course, these margin calls can amplify the moves. So I'm not going to give you an answer to this question, but I will say that for the listeners, I would say that the more interest there is in the gold market, the more interest there is in the silver market, I think the higher the volatility on the upside and on the downside we will see. And I still think that, I mean, for many investors, in fact, the ongoing pullback in the gold price is probably a chance, an opportunity to add to their gold holding. Because at the end of the day, if I go back to the permanent portfolio, I mean, if you look at the permanent portfolio, the neutral position on gold should be at 25%. And we know that we are in a macroeconomic environment where we cannot own contracts like bonds and cash. So in fact, the allocation to gold in the permanent portfolio should be at least between 40 and 50%. In fact, I'm going to write a newsletter this weekend, and I'm going to talk about the Banana Republic portfolio. And the Banana Republic portfolio is basically a portfolio where you buy 50% in gold and 50% in stocks, meaning this is a portfolio where you completely avoid exposure to contracts, because contracts like cash and bonds are toxic, are in fact the most riskiest asset to own. And you only own properties like gold and stocks. And why I call it Banana Republic portfolio, because this is a portfolio that in fact everyone should have owned if they would have lived in emerging markets, because when there is no trust to the institution, can be the central bank or can be the governments. In fact, investor can only own properties like gold and stocks. So we have seen this clearly in many emerging markets. I can take the example of Turkey quickly. I mean, Turkey has gone through a period where its central bank independence has been put into question. The central bankers have been replaced almost every 6 months by the president of Turkey at some point in time. And that's where we saw a sharp increase in the Turkish stock market, as well as the value of gold in Turkish lira. And so since it seems that the Western world and even the US is heading into this kind of environment where uh, central bank independence is no more respected by the political institution, I think that everyone in the Western world and in the world, in fact, should own a Banana Republic portfolio.
Well, this has been a wonderful discussion. I want to welcome everyone who's tuning in to this fantastic interview with Laurent, publisher of the Macro Butler. Before we wrap up with our final set of questions, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community, receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report you'll get. I'm positive that you've been enjoying the conversation Laurent and I have been having. Please let him know, hit the like and subscribe button, and leave a comment below the video. Laurent, we talked off camera a moment ago. Let's finish off our discussion with the asset ranking lightning round. Okay, I'm going to ask you to rank a few assets as a buy or a sell. Give it a score of 1 to 100, with 1 being an extreme sell and a 100 being an extreme buy. Then just give it 1 or 2 sentences as to why you take the position. We're going to try to roll through these as quickly as possible because it is a lightning round. Okay. All right. So right now on a scale of 1 to 100, is gold a buy or a sell, and why?
110.
I'm sorry, it's 110?
110, 100. I mean, it's a buy because until we have no solution in geopolitical conflict, until we have no improvement in all public institutions in the world behave, gold is a buy.
Okay. 1 to 100, gold miners.
I would say 80. Because I mean they will probably benefit from higher gold price. I'm a bit worried if oil price rise, their margin will be impacted, and I'm also worried that most government will try to get a share of this higher profit at some point.
Yeah, I couldn't agree more. 1 to 100, silver.
95. I would say like gold, it's a buy. Just why it's not 100 is just because silver is much more volatile than gold, and as of today, silver is not on the balance sheet of most of central banks.
Silver miners.
75 is the same. I mean, I think that they will benefit from much higher silver price, but once again, and especially because many silver miners operate in very exotic countries like Bolivia or Latin America, I'm not sure that the rule of law will be respected if their earnings grow exponentially.
That's a fair point. Okay, copper.
Or 80. So I think that like other source of energy and oil, it's a must own, and it's a buy if you have a 12 to 24 months time horizon.
Okay, uranium.
70. I would think that there's been a lot of hype in uranium over the past few months. I think that clearly nuclear power is one way to solve the energy problem, but it's a much more difficult business than oil and gas or copper mining.
Yeah. Okay, let's go to oil. 1 to 100.
90. I think that oil is completely under-owned and underpriced at current levels, and I won't be surprised that investors who enter today could double on the oil price on a 12 months time horizon.
Interesting. Okay, Nasdaq.
10. It's overhung. There are probably some good stocks, but not among the Magnificent Seven. So I would say that you need to do a due diligence in stock picking among the Nasdaq stocks.
Okay. The S&P 500.
I'm gonna put 70. I mean, because probably when the sector rotation has been done, the S&P 500 will do okay. But I think that the Dow will outperform the S&P, and they both will outperform the Nasdaq or on a 12 to 24 months time horizon.
Okay. Short-term treasuries.
Yeah. 10. I mean, is we cannot even trust the short-term maturity, because if we look at history, I mean, countries like Italy have at some point in time extended short-term bonds into perpetual bonds, or I would say 30-year or 50-year bonds. So it's all the trust that you have in the government. So it's 10.
All right, so you're at 10 on short-term treasuries. Where are you on long-term treasuries?
0.
Okay.
I wouldn't own anything beyond 6 months maturity, to be honest. There's no point, because, I mean, we are in a structural inflation environment, and it's not a 4% yield on the 10-year treasury that gives you any kind of hedge. It's a for sure return less asset.
Okay, on a scale of 1 to 10, each representing a percentage, where do you see inflation ending the first quarter of 2026?
Oh, I think that CPI will be between 3.5 and 4% by mid of 2026. We are entering, in fact, the second wave probably of inflation. And it's not really about tariff. In fact, it's more about the shortages and what I just exposed, that in fact we will see probably a boom in commodity prices, because there will be increasing shortages and supply will be impacted. And so we will see inflation probably between 3.5 and 4% in the
Okay,
mid
so
2026.
do you see that being like a new higher plateau, or do you see inflation actually escalating further from there?
Well, it all depends what's happening on the geopolitical front. I mean, if we go into a situation where I would say there's a direct confrontation between NATO and Russia, and where we have an extension of the ongoing conflicts to China and other countries, I would think that we could see much higher inflation by the second half of 2026. It's not really I mean, this is kind of the worst case scenario. I would think
Yeah.
that
Not
we
your
will
base case.
probably not the base case. I would think that we will probably see a 4-ish% CPI by the end of 26.
Okay. 1 to 10 probability that we're going to head into a recession by the middle of 2026.
Well, it depends on what you call a recession. If it's the BLS calling the recession, I don't think anyone at the BLS would dare to call a recession before the midterm election. This is clearly a very political call. I would think that what we are going to see, in fact, is a sluggish economic environment, sluggish growth, a much higher unemployment rate over the next 6 to 12 months. And on the other hand, we will see a structurally and sticky inflation. So we are slowly heading into this stagflationary environment. Would it be called a recession or not? I mean, as I said, it's all about the BLS calling that, and I don't think that anyone who want to keep its job until I would say post 2028 would dare to call a recession before the midterm election.
All right, I think that's a fair point. All right, so finally, you might have already answered this earlier, but let's just talk about it again. The recommended portfolio allocation for decades and decades has been 60-40, 60% stocks, 40% bonds. There's been no room for gold in people's portfolios. No financial advisors have been recommending gold. We're starting to see some type of shift take place. But in your mind, or in your advice, what do you recommend in terms of a precious metals allocation for a portfolio today?
Well, I just would just reiterate, I would recommend everyone to own the Banana Republic portfolio, a 50-50, 50% precious metal, which should be mostly gold and some silver and platinum, depending of your risk aversion, and 50% good quality blue chip companies, most of them among the Dow Jones members. Uh, I think that, as I just said at the start of this discussion, the riskiest asset today is bonds, and
Hmm.
especially government bonds. So I would say that owning treasuries and I would say anything outside 1 or 3 months treasury can be at risk, because if we see a stagflationary environment, cash will not help you in this environment,
In
and
your
bonds,
in your
yes.
50% bucket of gold or precious metals, do you also include mining stocks of the precious metals companies in there, or is that separate for you?
No, I think it's separate. I think the mining stocks are stocks at the end of the day. So I would allocate mining stock in the equity part of the portfolio. And as I said, I mean, the 50% equity allocation should probably be at least 40% made of energy producer, including industrials, miners, precious metal miners, and oil and gas, and all kind of companies that will benefit from this resurgence in commodity prices. And then the 10% should be the other blue chip, and I mean, including the kind of blue chip that we go through this stagflationary environment reasonably well, because they benefit from, if not a monopolistic, duopolistic position in their sectors, and they are the kind of companies selling products or services that everyone needs to buy to have a normal life. So, I mean, it's not an investment recommendation here, but I would put Walmart. Uh, I would even put a Microsoft in that bucket. I would put some cyber security stocks, some good quality semiconductor stocks. But clearly, I wouldn't overweight the growth stocks at the current level. I would, as I said, look at everything that is related to energy producer related companies.
Okay, wonderful. I appreciate you explaining that in detail. Laurent, thank you for coming on to Metals and Miners. You're always so generous with your time, analysis, and ideas. Would you let everybody know who's listening where they could learn more about your work and how they can connect with you?
Well, I'm writing the Macro Butler on Substack. Everyone can contact me at info@themacrobutler.com. I advise high net worth individual in this difficult, but also in this difficult environment, which is also full of opportunities. And finally, I will launch a website in January, themacrobutler.com. And I also will launch a financial academy next year, because I believe in financial literacy and I want everyone to be financially educated, to be financially free.
That's wonderful. It's been great to spend the time with you as always, Laurent. I look forward to having you back on sometime soon. Thanks again for being here with us. Everybody else, thank you for watching.
Thank you, Gary.
I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community, receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report you'll get.